Well, thank you again, everybody, for coming to the session, Investing in Vermont Using Place-Based Ownership to Keep Our Money Local. My name, again, is Arian Tabumari. And my co-host, again, is Matt Kropp with the Vermont Employee Ownership Center. So we all want to have strong companies in Vermont that are committed to Vermont. To give a little bit of an I'm going to give an introduction. Then we're going to introduce our panelists one by one. They're each going to talk a little bit about these alternative ownership structures that we're discussing today: ESOPs, cooperatives, steward ownership. We're going to give a little overviews of those, each of our panelists, and then we're going to move into a larger discussion about how these structures, how does investing in these structures look, and how they see it from being inside companies and also from being investors, some of our panelists themselves. So look forward to lots of discussion around that. So just to provide a little bit of overview, I think folks are coming here because we all have strong interest in Vermont and we're committed to Vermont. And yet as companies grow, many entrepreneurs and investors see their only option is selling to larger companies, and those are generally out of state. And when ownership changes, so can other things, from policies on employee compensation and ethical supplier commitments to changing the company's entire mission, and sometimes the business even leaving Vermont. And so today we're here to discuss other options. There's a number of other great company structures that exist. As I just mentioned, there's cooperatives, employee stock ownership plans or ESOPs, and steward-owned companies. These types of businesses are often around us without us even thinking about it. And many of us are already members of grocery cooperatives. We shop at places like Gardner Supply, which is an ESOP, and one of our speakers has been with the company for many years. Ace Hardware, which are all members of a larger co-op, and we use King Arthur Flour, which is also an ESOP, in our homes, and a great Vermont company. Any business can use these models, and these models can be harnessed to help companies commit to place and principles in ways that don't change, even as ownership changes over time. So today we're going to discuss how these models work, how are they different, how are they similar, and then spend the bulk of our time focusing on how can we, as investors, think about investments in these type of companies. So to facilitate conversation today, please put questions into the Q&A. Probably depending on your screen use, you will have something that says Q&A. The chat function is actually not enabled for attendees. Put it in there, and Matt and I will be monitoring that, and we will make sure that your questions get answered. So our first speaker today to give an overview on ESOPs is going to be Jim Feinson. And for the past 20 years, Jim was president and CEO of Gardner Supply Company. I'm sure a company that most, if not all of you, are familiar with. It's one of Vermont's most prominent and successful employee-owned businesses. He left the role at the end of this past December and is now serving as a corporate director and strategic and executive advisor, specializing in startups, family-owned and employee-owned businesses. So Jim, if you want to take it away, please.
Thank you, Arian. Okay, so to begin at the beginning, these are all models that are very prevalent in Vermont, but we may not, all participants may not be familiar with them. So let me give a 5-6 minute overview about this thing called ESOPs. Let's just hang on a second. Okay, so what is an ESOP? An ESOP is an employee stock ownership plan. And at the highest level, it's a tax-advantaged way to get ownership into the hands of all employees. That doesn't just mean the founders or the investors, but it means every full-time employee who might be working in that business. So let me review briefly how an ESOP works. Essentially, all employees have an account with the ESOP, and there are 3 ways to get shares into those employee accounts. The most common method is acquiring from selling shareholders. So this creates liquidity for founders and other investors by buying shares for ESOP accounts. You can also issue new shares, which leads to dilution for existing shareholders. And then once the ESOP is established, then there is a repurchase cycle. When employees leave, the company buys back their shares and redistributes them to other employees. But a key takeaway is that employees are not paying for these shares. They're not purchasing the shares. They are contributed to them every year as an employee benefit at no cost to them. Also important is that shares go into the accounts tax-free. It's totally analogous to a 401k account. There's no tax incurred when the employee receives the shares, and there's no tax incurred as the account, we hope, grows in value as the share price goes up. It's only when the employee takes their money out that the employee ends up paying the taxes. Why do companies use ESOP? Most typically, they're used for ownership, liquidity, or succession. Entrepreneurs think that they can do just about anything, but no one has figured out how to live forever. So succession is something that all owners are going to face. And so this is a way that they can get just some liquidity by selling a portion of their shares to a ready buyer at fair market value, or in the case of a 100% ESOP, to do 100% succession selling to the employees. And you choose an ESOP, a lot of buzz because of the tax advantages to the company, and in certain circumstances to the selling shareholders. And without getting too techie, if I can give a quick summary, the ESOP is actually a trust, and like a 401k, it's a non-taxable entity. Well, if you're familiar with an S-corp structure, in an S-corp, the earnings pass through to the shareholders for purposes of taxation. Now, if you're a 100% ESOP, S-corp ESOP, that shareholder is this non-taxable ESOP trust. So the company doesn't pay taxes, the ESOP doesn't pay taxes, and so no corporate taxes are paid. If you're making $1 million in profit, if the top corporate tax rate is 21%, that's $210,000 of additional cash flow available to the company every year. In addition, under certain circumstances, selling shareholders can also defer or avoid capital gains when selling to an ESOP. So a founder who may have very low basis, when they sell their shares, they can defer that gain, and through estate planning can even avoid that tax altogether. But while that's a reason that ESOPs get a lot of attention, I don't think that's the most important reason to consider an ESOP. And I think the more important reason are the philosophical values, to operate true to the reasons the company was often started. And one of these can be to create the more equitable distribution of wealth. Typically, in most business transactions, it's the financial capital that gets a disproportionate return. We've heard in other sessions about, VC might want to get 2 to 10 times return on their capital. Well, the employees are also helping build that company value through their physical capital and their intellectual capital. And through an ESOP, as they build value, they're getting rewarded as well, and they're sharing in that gain. And really, the most critical piece is to create an ownership culture. When employees have shares and you educate them, they think and act like owners. Everyone has skin in the game, and it creates tremendous alignment, all about building that company value, that share value, and it drives better results. So there's a lot of choices for succession. We're going to hear about some others, and why among these would you consider an ESOP? Well, one is that it is a government-regulated retirement account through ERISA, you may have heard of, under the Department of Labor. But that actually provides a sort of a guaranteed fairness and protection to employees, a well-established, well-understood structure that's been operating for many years. It's also very scalable. An ESOP can be only a 5% equity holder, where 95% is held by other traditional founders and other traditional investors. Or it can be 30, 60, all the way up to 100% ownership. But I think for purposes of this conversation, it's not a startup model. It's something that needs a certain size and scale and stability to operate. So in the example of Gardner Supply, we were founded in 1983. I think we adopted our first ESOP in 1987. We had 4 years. We were still a very new company, but had, I think, 30 or 40 employees and a few $1 million in sales, and we're at the scale where this could work. And to this overall topic about place-based investing, this is, I think, the most important reason this should be of interest to this conversation. Vermont has a lot of ESOPs. I think Vermont's new tagline should be winning per capita awards since 1791. So on a per capita basis, Vermont is near the top in the country for ESOPs per capita. And we have this outstanding ESOP community supported by the Vermont Employee Ownership Center and great networking that we have. And ESOPs are a way to keep great companies in Vermont. And again, Gardner Supply is a terrific example. Will Rapp, our founder, ultimately, of course, wanted to get liquidity. He put in tremendous investment and sweat and risk and wanted to get some liquidity and also think about who would be the next owner. A very common and easy path would have been to sell to a large out-of-state company. And we generated tremendous interest. Gardening's a great business. We have all this great spring and summer revenue that a lot of companies are really hungry for. And we would have joined a much larger organization, and we can pretty much guarantee that our call center, our warehouse, probably most of the jobs, if not all the jobs, would have left the state. Instead, by choosing to sell to the employees through an ESOP at fair market value, we've kept Gardner Supply in the community. We've kept King Arthur in the community. We can keep Switchback in the community and PC Construction. So it's a way to keep great companies in Vermont, and that's why we hope founders and others will consider ESOPs. So with that, let me stop sharing. Turn it back over to Arian.
Great. Thank you, Jim. Really great overview there, and appreciate the personal insights and the sort of larger philosophy. Our next speaker is going to be Greg Brodsky, who's the co-director of Start.coop and the Equitable Economy Fund, which Start.coop is an accelerator for shared ownership businesses, and the Equitable Economy Fund is an equity fund that invests in shared ownership. And Greg was also previously the board chair of the Cooperative Development Institute. So Greg, if you want to take it away, thank you.
All right, thanks everyone. Sorry about that. So nice to be here. So let me just share my screen. And all right. All right. Almost had this right. Whoa. Okay. See if we can get there. All right. All right. Thanks, everyone. My name is Greg Brodsky. I am the director of Start.coop. And I'm going to talk a little bit about co-ops broadly. Alan's going to talk a little bit more about converting to co-op ownership, so you can think about that compared to ESOP ownership. But co-ops are this funny word in that everyone's heard of it, but very few people can accurately define what it is. Let's see if I can get rid of this. In fact, we know that 78% of consumers are more likely to buy from a cooperatively owned business, and yet 89% of people can't accurately define what the word means. So there's this halo effect around the word where even if people aren't sure exactly what it is, they know it's a better alternative to traditional winner-takes-all capitalism. I think we're all familiar with traditional ownership, where a handful of people get rich while the people supporting the business get very little. And really what cooperative ownership is about is, what if the people who support the business actually own the business? Where it gets complicated is that cooperative ownership can exist at any level of supply chain. So you can have a consumer-owned company like REI or Onion River. You can have a worker-owned company like Equal Exchange. You can have a small business-owned company. Ace Hardware is a co-op owned by 4,000 local hardware stores. You can even have at the top level of the supply chain, you can even have a farmer-owned company like Cabot Cheese, right? And so any level of supply chain, any sector, I think this is where people are like, well, what does REI have to do with Cabot, have to do with Onion River, right? It's an ownership model. It's not a business model.
Greg, sorry to interrupt you. We are seeing a white screen. I just wanted to make sure that
oh my goodness.
Yeah.
Okay. I'm so sorry. Let me try something different here. That's so strange. Sorry, folks.
Apologize.
That's all right. That is really weird. Nope. All right. Can people see my screen now? Thank you, Arian. I don't know how much you missed, but so we have different examples of co-ops at different levels of supply chain. You missed my beautiful slides, but just imagine how gorgeous they were. And so one of the misses is that co-ops are small, that they can't scale. The reality is that the top 100 co-ops in the US do over $228 billion in total revenue. So clearly they can scale. But one of the questions we get is, if co-ops are so great, then why aren't there more of them, right? The reality is, fewer than 1% of new businesses are cooperatively owned. And there's these three reasons that keep coming up. One is this misperception problem that, as we mentioned, only 11% of people can accurately define what a co-op is. Number two is the lack of support, that there's a lot of entrepreneurs who want to create businesses that are cooperatively owned, but they don't always have the support systems. That's why We created Start.coop to bring people the knowledge and skills and tools and mentorship. And finally, the financing that we observed a lot of our entrepreneurs coming out of our program and other entrepreneurs we've met, where not that every business deserves investment, mind you, but being cooperative presented some unique challenges and needed some unique term sheets. And so we've really spent a lot of time thinking about that. So one of the things I'm going to talk about a little bit more later on in the webinar is this pilot fund we've created that's called the Equitable Economy Fund. It's a $2 million fund, so fairly small in the fund world, that is specifically designed to target cooperative ownership at the seed stage, growth stage, and mature stage company to try to provide the unique financing. And so I'm going to let Alan talk a little bit more about conversions, and later on in the webinar, I'll come back and talk about some of the unique term sheets that we're seeing for cooperative ownership structures.
Great. Thank you very much, Greg. Sorry, I didn't jump on that sooner. I thought maybe your first slide was blank and then it was going to go. So thanks for everybody's patience. All right, great. So next, Alan, if you could, Alan Matson is a 35-year career in the financial sector and focusing on market finance. Although most of his career has involved the traditional financial markets, he's also served on the board of the Onion River Co-op and was a founding member of the board chair of the cooperative that bid unsuccessfully for Burlington Telecom, which is ultimately privatized, but long and storied history. So Alan, if you would please take it away.
Yeah, thank you. Thank you, everybody who's come before. And I'm going to try to build on a few things that we've heard from others so far, but I'm going without slides today. I'm going to pretty much talk through challenges and what we tried to do with Burlington Telecom and why we did it as a cooperative. I think that there were a number of us in Burlington who said once the city of Burlington was going to have to sell Burlington Telecom, we came together and said, the right way to do this is as a cooperative. And there's several reasons why. Again, as a consumer cooperative, we wanted to align the interests of the viewers, of the users of the ISP, of the users of the phone service with the ownership structure of the entity. And there's classic examples. I mean, all of rural America pretty much got wired and set up for phone via cooperatives over the years. So these were startup entities at the time, but everybody's interests became aligned, and that allowed them to come together and build all the wires that we see across rural America. Burlington Telecom, of course, was slightly different in that the infrastructure already existed, but it was a classic case where we're in a competitive environment. If we can align the interests of our customers with the organization of the company, which cooperatives do, then we felt we were going to have a really strong competitive position for maintaining our customers and growing our customer base within Burlington, as well as serving directly the needs of the Burlington customers. So that was the basic idea and what drove us and why we put together a group that we organized as a cooperative to purchase Burlington Telecom. I can't say that everything we did in that setup may have been technically the best way to do it, in that maybe it was better to set up not so much as a co-op at the start, but as an entity that was going to convert the municipal telecom into a cooperative once it was purchased. But we did start up this way. And the immediate challenges that we ran into is that we were going to need to raise between $10 and $20 million, because this was not a situation like an ESOP where we could buy the entity over time. We needed to put money on the table and make a bid. And, Greg's already touched upon some of the issues with financing and some of the unique setups that you're going to have in a term sheet for a cooperative. And as we went around trying to get financing, that became pretty clear right away. We met with banks, we met with government entities, we met with cooperatives, through credit unions. We met with various other individuals, all of whom could have provided financing. And in the end, we actually hit upon a group that was in the telecom industry who was willing to put together the kind of term sheet that we needed. That group was out of Maine, and they saw what could be done. They recognized that there was a huge amount of value here, and they were looking for the kind of returns that you could get from a cooperative. Now, what we have to remember in a cooperative is you're not going to get your X returns. You know, when the venture capital folks are saying, I want my X returns 2, 10, 20, 30, whatever that X is, that's not the kind of investment that is going to make for a big investment in a buyout of a cooperative. You certainly can make a solid big percent return because you're going to have a subordinate type fixed income instrument, but you're not going to be able to earn X returns. And we found a party who was looking forward to that, who knew the industry and was willing to do that. We had a couple other parties express a lot of interest in perhaps investing, but the concerns they had were much more control based. And again, large investors coming in probably want to have more control than a cooperative is able to give, in that cooperative ownership allows for one person, one vote, truly democratic. It's not something that the large investment community is already schooled in. So this, I think, as we're looking at converting a situation to a cooperative where the interests of the entity in itself get aligned with the interest of the owners directly, builds great consumer loyalty. Those situations are perfect for trying to do a cooperative ownership takeover. But the issue really will become, how do you raise that capital right up front? I think it continues to be an issue. Would love to hear more about what Greg is going to say going forward. And also, I would love to weigh in further on some of those issues and maybe discuss them again as we get further down the line. But at this point, I'd like to cede the podium and turn things back over to Arian and Derek.
Thank you, Alan. I look forward to hearing more about some of your further thoughts on how to make these kinds of transitions. I know that it's a really important question and very timely, I think. So our next speaker is Derek Razzo, who is co-founder and partner at Purpose Network in the United States, where he specializes in large-scale ownership transactions, alternative financing for startups, as well as corporate and trust governance. Derek has supported many businesses, communities, NGOs, and funds on creating equitable ownership, finance, and governance structures. So Derek, if you want to take it away.
Great. 1 second. Okay. Hopefully you can see my screen now. Hi, everybody. I'm Derek. I'm going to shake up the co-op focus a little bit to talk about steward ownership, which is kind of the third model that Arian mentioned, and is a little bit different. I have the benefit of going last, so I'm able to talk a little bit from the footing of some of the differences, and hopefully we can bring that into the future of the conversation. So I like to say that steward ownership is the oldest ownership movement that you've never heard of. And I'll talk a little bit about examples and historical examples later. But just to kind of recenter on why we're here, as investors who are locally focused, we have the opportunity to deploy capital in a way that achieves a certain set of goals that may not be achieved in a conventional deal. This is about growing community wealth, keeping jobs local, allowing communities to be self-determining in the long term, and to create institutions that actually increase the health of our economy and democracy in an intergenerational way. This is the sort of golden opportunity of investing locally. Purpose helps do that, and we help set up these new types of institutions. And just to start, on the foot of a little bit of why this is different than something like an ESOP, you kind of have to look no further than this recent example of the sale of New Belgium, which is a independent brewery in Colorado, to Kirin, which is an international holding company with some human rights violation charges. So New Belgium was an ESOP. It had a sort of conventional investment structure that allowed the founder to kind of get liquidity and move the ownership into one of these ESOP structures that we've just heard about. But recently, the workers and the trust voted to sell the company to Kirin. And this was kind of like a very confusing moment for the alternative ownership sector, because half of the folks that we know are saying this is a victory. These folks, on average, got $100,000 to go put a down payment on a house or whatever. And on the other hand, half of the folks in the sector are saying this is really sad because we've lost this community institution. We've lost this this pillar of the community that is not just holding up jobs and not just creating wealth, but actually, pushing the community forward and allowing, people's kids are getting jobs here, and we don't know what's going to happen. Like, this will be an interesting story to see how it pans out. But the reality is that with a lot of these conventional investments, this is how it ends up, right? You need to eventually create liquidity, either for repurchase obligations or for founders or for investors or whatever. And the way to get those returns that we're talking about, VC or private equity returns, the way to get those returns is to sell the company, right? You can also IPO, but a lot of these local businesses don't really IPO. And so eventually these jobs go away. So if we want to create real prosperity in a community and local based way, we actually need to rethink a little bit how we construct these companies so that we can build intergenerational institutions. And that's what we're focused on. So the main way that we do this is through creating steward-owned companies. And just to talk about the background, what's the philosophy behind this? Stewardship, we think of it as a philosophy of managing assets for the long-term benefit of a common purpose, rather than simply profit or markups or account values or financial gain. In order to do this, we recode the basic legal and capital structure of a business, and we change the fiduciary duty from being to serve capital first or to serve a single group of stakeholders to serve a purpose. And the stakeholders are often involved in the governance, and we'll talk a little bit about examples of that. But this is really the key difference, is rather than serving a specific group of stakeholders like the farmers or the workers or what have you, these entities actually have a common purpose that is their main objective. So when we talk about steward ownership, we're really talking about a field of ownership structures, not just one thing. And the field of ownership structures really have a couple things in common. So one is they are steward owned, meaning that they're no longer a commodity. We've broken the link between money equals power. Value cannot just be extracted into perpetuity by a foreign holding company or whatever. Upside is shared among stakeholders. Stakeholder governance, this means that people who are connected to the mission, people who are in the community, people who work in the business, people who really have a stake in the company for one reason or another and who are connected to it, are actually involved in the governance in some way. And we can talk about examples of that if it's interesting. And then inclusive financing. So the financing structure is inclusive of the people who generate value and who create value in the business. And this goes often beyond just workers, right? Like the people in the community are often co-owners of steward-owned businesses, and they contribute to the value by shopping there, by creating value, by telling their friends. Supporters online, there's all kinds of different ways to create inclusive financing structures with steward-owned companies. So, the key thing from our perspective of looking at local investments is what happens when a company spends 10 years growing and then is ultimately sold. Massive amounts of wealth are generated for investors and founders. And then in the case of an ESOP, a select group or a generation of workers. In the case of a worker co-op, that can be, or a multi-stakeholder co-op, that can be even further. But with a steward-owned business, 10 years later, the business is a community pillar. It's still rooted in the community, and its fiduciary duty is set up around that purpose. Usually we do this with a trust structure. The most common one in the US is a perpetual purpose trust. It's not super important to understand the dynamics of how that works. The transaction structure is really similar to an ESOP. You're able to do sort of seller financing or equity financing to move shares into this trust. And the trust redefines the fiduciary duty of the corporation around its mission, and redefines the governance of the corporation around the stakeholder governance ideas. An example is a company that we converted in Oakland called Firebrand Artisan Breads. 33% of the company is now owned by the Firebrand Stewardship Trust, which is co-governed by the founder, the workers, and community NGOs. The company's mission is to create employment opportunities for people who are formerly incarcerated. And now that trust, as a shareholder, is permanently endowed with the ability and a board seat to protect the workers, to protect the mission of creating job opportunities for formerly incarcerated people, and to protect a profit sharing program that is the equivalent of what you would get in a worker co-op. So you can see how this is similar but different, right? There's a sort of There's a gestural difference. Excuse me. Another example is Organically Grown Company, largest distributor of organic food in the Pacific Northwest. They're about to become 51% ESOP owned. We helped them convert into a fully steward owned company. And they're now co-governed by all the parts of the supply chain. They just set up an equitable loan fund that is going to hundreds of co-ops around the country that have been impacted by COVID-19. So I said in the beginning, this is the oldest ownership movement that you've never heard of. There are tons of examples globally and in the US of companies that are set up like this. And the reasons why people tend to choose these structures are, flexible capitalization. We can actually use instruments that are a little bit closer to conventional capital instruments. Flexible governance, we can include different stakeholder groups, and we can actually balance powers in a little bit more of a subtle way than the sort of one stakeholder, one vote kind of structures. They're very simple to set up and manage. They're free from some certain types of burdensome regulations that subchapter S or subchapter T co-ops and ESOPs are beholden to. And they have really simple tax treatment of stakeholders. So, there's a ton of impact reasons why folks choose this that we've talked about. I think I'm headed towards the end of my time, but the main thing I want to say is this is a fundamentally different way of doing economic development in a local economy. This is about creating self-determination in these communities, and it's a different way of organizing who controls and who benefits. So we think this is one of the best ways to leverage your capital as a locally focused investor to actually make sure that if your investment is successful, it has an intergenerational impact in the area that you're investing in. Thank you.
Thanks, Derek. I appreciate those comments, and I know that's a lot to try to fit in a short amount of time there, and I hope we'll unpack more of that as we discuss forward. I know that one of the things that came up in our conversations prior to this amongst all the panelists is that all of you have said that you've seen some of these arrangements in companies where there'll be part ESOP, part purpose-owned trust, and maybe have a cooperative element in a different way, and that some of these models can be as simple or as complicated as you want to make them, and may have different reasons to have different parts take on different forms to find the right balance that folks are looking for. So I think that we should see these all as sort of arrows in the same quiver, so to speak. That's right. So shifting gears a little bit, would like to, our next portion is just to ask every one of our speakers to talk a little bit from their own experience of how they see investing in alternative ownership look like. And if they had a few key points that they'd each like to share, we'll kind of go back through the same order, just a few points, and then kind of open it up for conversation between you guys. And then we have some questions that are queuing up in the chat. And so maybe Jim, if you want to just kind of, if you had any things you wanted to share out of the gate.
Yeah, thank you. And let me come back in and shift to this perspective of investing. Hang on just while this kicks in. And I think that was a very important point. There are a lot of different models here, and ultimately I think this all really starts with strategy. Different businesses have different capital needs, they may have different strategic alignment needs, and so it's not only about ownership culture per se, but it's how that ownership structure fits with the overall strategic plan that will make the business successful. For ESOPs, let me talk about ESOPs and investing. I think as I spoke about earlier, ESOPs are not themselves a way to bring in growth capital. The employees are not spending their money to buy those shares. Investors are not coming in from the outside to buy ESOP shares. It's a benefit to the employees, and it's a way to get employee engagement. But for outside investors, why would they invest in ESOPs? I touched on some of the tax shield opportunities, and that often makes an investment in ESOP a lower risk investment. There's enhanced cash flow because of the potential for that tax shield on corporate taxes. And again, in some instances, the investors themselves can get a tax shield, which can certainly help enhance their returns. But I think really the reason is that From an investor's standpoint, employee-owned companies who adopt this employee ownership culture outperform their peers. We've seen this throughout history. We've seen it throughout COVID. One of the largest private equity firms in the country is called KKR, Kohlberg, Kravis, and Roberts, initially. They've got $535 billion that they invest. And they have a huge impact fund, which looks for companies that have employee ownership or participation, not because of a philosophical bent, because they outperform their peers. And so it's a very powerful way to engage all employees. So if you wanted to invest in an ESOP, how would you do so? One is lending money to ESOPs. That can be lending money to help with the ESOP buyout or in any other form. And this is like traditional lending. You can be a mezzanine lender. You can be a mezzanine lender with warrants to enhance your return. All this can fit very easily with an ESOP model. And I mentioned there can be traditional investing with an ESOP component. So you could have a minority ESOP, which gives those employees a stake in the game, while there's a traditional investing component. The ESOP can become a liquidity alternative for investors. So it's not only the founders who are able to sell shares to the ESOP, it's all investors. At a time, I was a non-founding minority shareholder of Gardner Supply and was able to ride along and get liquidity out of that investment myself. And it can be on a path to a traditional, I put traditional in quotes, exit. Derek spoke about New Belgium brewing. I think the takeaway is that ESOP companies are like any other companies. They actually go out of business. Sometimes they don't succeed. Sometimes that ESOP is not the right strategic model to maintain success. But on the other side, they also sometimes get sold. And this has happened in Vermont. Kalo Technologies down in Rutland, or Sonex Industries in Bellows Falls that got a lot of press. They ended up 100% ESOP companies that sold to the outside. But I think what's really critical there, that was the choice of the employees. For that be the way for the company to be sustainability and for them all to kind of share in that benefit of the value that they have created. And there can be even sort of special circumstances. ESOPs, they're, because it's a set up by Congress with tax advantages to motivate ESOP setups, it creates all kinds of interesting opportunities. There can be a traditional investment, but in a subsidiary of an ESOP. So an ESOP might create its own startup and bring in outside investors. ESOPs can be a great vehicle to create future acquisitions. And when you acquire another company that may be taxable and make them non-taxable, that enhances the cash flow. So that can also be a way to participate with ESOPs. There are even ways to use preferred stock to get high dividend returns and while creating that ownership structure. I think the most important reason to consider investing in a company that has a partial or may even be on a path to 100% ESOP is from impact investing. Impact investing, is to make a difference. And I think impact investors always talk about measuring that. I talk about measuring tons of CO2 that might be removed from the atmosphere or gallons of clean water created. But when you talk about making an investment, what greater impact can we create than build wealth of those typically disenfranchised from investment gains? After a long period where the wealth disparity has been increased, this is a way to really change that dynamic. And this is a model that all sides of the political spectrum love. Democrats love it because it shares the wealth. Republicans love it because maybe there's a tax break and everybody becomes a capitalist. But the key is that all employees get to participate in the wealth that they are creating. So I think that for any sort of investor, an ESOP is something to be considered. And so I think it's worth exploring and getting advice. And I've listed here some of the both local and national organizations. And I'm also happy to talk about this myself to learn more about the ESOP model. And I will now turn it back. Thank you.
Awesome. Thank you, Jim. Appreciate that. I always appreciate the humor that you bring to your points. Yeah, Greg, do you want to take us through some similar investing considerations on co-ops from your perspective?
Yeah, and I just want to point out for folks watching this webinar that there's really kind of two levels of conversation happening here, right? So one is these three different ownership models you're being presented with that I think are really different flavors of the same intent. How do we share governance rights? How do we share power? How do we share profits with the community and not just outside shareholders? So I think there's a similar intent here, even though we're different flavors of it, just to give some context. And maybe this will come up in the Q&A. And so this section is really sort of about if you want to invest in any of these flavors, what is the way to do that? So I'm going to talk to you about how we think about investing in co-ops, but I think some of the points I'll make will actually be common to all three ownership models, or I hope we'll find out. So I'm going to try to share my screen. Let's see if it works this time. So you guys can let me know here.
Looks white again.
Okay, looks white again. Okay, hold on. Jeez, what is going on here? Sorry, folks. Oh my goodness. All right. I don't know why I'm having issues. Can you guys see my screen now?
Yes, there now.
Great. So let's go back here. All right. So the challenge that Alan so eloquently pointed out is that outside financing is difficult for co-ops sometimes. And so what we see is that at the startup stage, we see fewer co-ops. And even at the more mature company stage, that sometimes that undercapitalization impedes business growth, because generally, there have not been a lot of outside equity shareholders in co-ops. The landscape has been that if you want to invest in co-ops, you can do it through a loan fund. Here in New England, there's a great loan fund called Cooperative Fund New England. You can lend to them and they will lend to co-ops on your behalf. And you might earn back 2 to 4%. We saw our graduates at an early stage needing financing, and we realized that equity would be a better fit for startups and also for some of the projects that are later stage that might just need more capital or different multiples of return. So we've been experimenting with a project that we call the Equitable Economy Fund that I'll just, again, briefly talk to you about. And so the idea is to invest in startup and growth stage cooperatives. So these are a handful of the co-ops that we have been talking to. We have a driver-owned data platform for gig workers. We have a Black-owned ag tech company that grows CBD products. We have a patient-owned healthcare research platform. Uproot is a consumer-owned platform for active duty military to share in the benefits of home ownership. Each of them are different. What they all have in common is they're owned by that community. So it's another way of locking in purpose. And so the question comes up is, okay, how do you invest in a co-op, right? What does that mean? And I think this may be common throughout each of our 3 models, but we'll find out, which is that investors need to be paid back out of actual company revenue or profit, not some grand exit, right? So this is probably the most different thing of an early stage investor is that, for what we're doing, we're either doing revenue share agreements. Sometimes people call this revenue-based financing, where we buy shares in each business. And then the company is allocating a small percentage of revenue to pay back investors at a multiple. So this could be, anywhere from 1 to 4 times the initial investment. And so we call this a structured exit. Or it could be a profit share or a target dividend agreement. So, maybe a 4 to 9% yearly target dividend. But it's out of company revenue or profit. And the reason for that is when you think about what we're trying to do with cooperative ownership, we are trying to create long-term ownership within the communities of each company. We're not trying to sell it and move on. We're not trying to flip it. And so that's why the investments have to be based on actual company revenue or profit generally. There's some exceptions, but I think it's the easiest way to think about it. Very briefly, this is just sort of how we think about a year of investments in the fund, seed stage, growth, and mature. The other thing I wanted to touch on is what are the additional considerations if someone were going to invest in a cooperative? And so the main one being that investors can't own more than 49% of the company. So it used to be that you couldn't have any investors in co-op, and now that's been unlocked now. But the red line is, if investors are getting 51%, we would say that's not a co-op anymore. It might be a shared ownership company, but it's not a co-op. The investors are typically receiving preferred stock, and in co-op, the members get the common stock, and the investor shares are typically non-voting, but it really depends on the co-op. They can have observer board rights, they can have a minority board seat or seats, and that varies by co-op. And finally, kind of going back to the intent we all have, which is, how does the community benefit from this, not just the investors? On the left, we have, what happens in most companies, right, where the investors own the majority of the company. and maybe the employees or someone else has a little bit of it. What we're saying is we think the community should own the majority of the company, right? And that's really at the heart of it. So the community is the one benefiting from these two rights, from the profit share right and the governance rights. So, and I think Alan is going to talk a little bit more, hopefully, about conversion financing. So I'm going to pause there so we can get to some Q&A.
Great. Thank you, Greg. Alan, do you want to jump in on that?
Yeah, let me just take off from where Greg started asking about the conversion idea, and it gets a lot to what you were putting up on your screen, Greg, in that when we established basically what would have been, for lack of a better term, mezzanine financing for us to get our transaction done, it was all going to, of course, come out of cash flow. And the party, as we talked to, since they understood our industry, this was not a financial investor, this was actually an industry investor. And because they understood our business, they could look at the business, the business model, they could look at the projections, they could look at everything in the company, well recognize that there was stable cash flow that was going to pay them back. And then we paid them like mezz or subordinate debt. They were going to get a nice percentage return. And in fact, it was a percentage return that, because this actually became a political transaction as well, as part of the city, that became actually a target. Like, why are they getting paid so much? Well, the truth is they were getting a percent return commensurate with having a subordinate position, subordinate primarily to the cooperative itself, which is a different type of subordination. It's not subordinate to a bank loan. It's not subordinate to other shareholders. It's subordinate to, and I think in the stewardship version, you would say to the goals of the stewardship. And yet they were going to get the return they were looking for. A key there was finding someone in the industry. I think that getting this idea of a different form of subordination understood by investors could be good. We had structured this as straight debt. We didn't have any kind of equity kicker. They were going to have observation abilities, and there were certain covenants that they had written in about what we could spend money on, what we could do without, and then what would need their approval. So for example, additional capital spending could only occur after cash flow had reached certain multiples of debt service or at the approval of the debt holder. So these were the types of things that we wrote in so that we could continue to manage the company. And at certain points, we would actually then have full range of decisions, but how much decision-making ability did we have to cede to the debt holder was a key question for us. And I'm going to kind of stop talking there. I just wanted to talk about the specifics of our debt, but I will say that in a conversion, one of your classic sources of capital is going to come from your members. And in the conversion, before it becomes a cooperative, you don't really have access to that capital. We did go to the community and had commitments of, actually commitments of upwards of $1 million from the community. And this was even before we could go to members. So members are also going to be an important source of capital. They will typically be even subordinate to like the debt holders that we had. So this capital stack in a conversion gets difficult to truly tap into until it has converted. And that's why in part, we had to go to full debt to pretty much finance almost the entire transaction, which is also what kept a lot of traditional lenders away, in that they weren't going to have the type of collateral they were looking for. So again, aligning investor, in this case, another telecom company, who understood the business, with our shareholders / member owners, that was a key that actually was able to help us get the financing, and probably is a key to big financing projects within the cooperative world going forward. And I could speak a bit more to those too, but I'd love to hear more again on some of these, on some of the other pools of funds that are out there, as well as hearing from Derek about this idea maybe of how do you pitch subordinating the return on investment to the stewardship model. So with that, I'll sign off.
Thanks, Alan. Perfect segue to Derek.
Cool. Yeah, I think as Greg said, there's a lot of similarities in the financing of any type of alternative ownership model. So I have like a little list that I'll just go through. I don't have a presentation, but I think it's helpful just to talk about, like, if you're interested and you want to go out and do a deal, what should you expect? Like, what are the kind of hiccups that you might hit, and how is it different than a normal deal? So the first piece of advice that I would give to an investor trying to go into any of these models is that you should allocate a little bit more time to understand and support the deal than a conventional, especially if it's a startup deal. But even with a mezzanine financing or a conversion deal, you're going to need to actually engage a little bit deeper with the deal, because it's going to have, all the mechanics that Alan is just talking about, right? And so knowing, in order to evaluate the risk return spread that you're going to be engaging with, you kind of need to spend a little bit more time. So I think time is the first key piece of advice I would give to investors. The second thing that we see a lot of people hurdle on is exactly what Greg said, which is you have to be ready to rethink your exit. So structured exits are probably the best fit for this type of thing, which Greg mentioned, which are, they come out of cash flows or profits or whatever. The other method that I don't know if you mentioned that we've used a lot is a recapitalization financing. So actually, when a business is, planning to recapitalize some of the investment liquidity throughout the process of the business growing. So it changes your growth rounds to sort of growth and liquidity rounds. You are more focused on profitability because you want to be able to access debt facilities. These are sort of differences in how the financing planning is going to go in the long arc of the company that actually affect the everyday strategy, and they actually affect how you grow the company and how you do sales and stuff like that. Third thing I would say is that, excuse me, a lot of investors are really freaked out by the idea of sharing power. So co-governance is a sort of hot topic in all of these structures, and there's a spectrum, right? So on one side of the spectrum is like one worker, one vote, maybe, and a subordinated debt note, right? That's one type of co-governance, and on the other side of the spectrum is investors are on the board and workers are on the board, and they need to find consensus in order to make certain types of decisions. I think that can be a really powerful mechanism for creating this ownership culture that we've been talking about. But go into these deals knowing that you're going to need to navigate some kind of co-governance. The other thing I would say is that a lot of investors get tripped up on certain conventional terms that they see as essential to achieving the return they want or having the types of control that they want. So, the conventional way of arranging board structures is obviously going to be a little bit different depending on which of these structures you are talking about investing in. Things like drag-along rights, tag-alongs, like things that allow minority shareholders, in this case, preferred investors, to make decisions on behalf of the whole company, are really antithetical to the idea of sharing power and sharing wealth, right? So those terms should be off the table, not necessarily as bargaining chips, but just in the spirit of the deal. The other thing I would say is that I think we as investors have to be a little bit more responsible and realistic about financial models in these types of deals. I've worked a lot with startups, and I've worked also with mid-sized companies. This is less of a problem in like mid-sized company conversions, but with startups, there's this sort of like everybody knows thing that happens with investors, where everyone's graph somehow goes up and to the right in a hockey stick. And with these types of structured exits, we have to be a little bit more judicious about how we think the company is going to grow, what kind of repayment burden we think the company can actually pay back. Like the capacity and the sophistication in the financial modeling has to be at a higher level, because we're really talking about paying back the money. We're not just talking about growing users and then selling to Facebook or whatever. And I'm sure that that's something Greg can talk about with a lot of the start.coop folks. Yeah, and the other thing I would say is, if you're an investor who's looking to do these types of deals, be a lead. Like being a lead in one of these deals can make all the difference. We've had very few failed financings of companies that we've supported. And part of the reason I think is that lots of people are interested in this stuff, but folks are there's a lot of hesitance to leading a deal. So I would highly encourage folks, if you're really interested and passionate and you think this is like a thesis, generally alternative ownership is a thesis that you want to start investigating and looking into, like do a deal. That's the best way to learn about these things, and lead, like try or find somebody who you can co-lead with who knows more about it. Yeah, that's what I would say.
Great, thank you, Derek. Appreciate those points. And we're going to shift gears into Q&A, and I also want to invite panelists potentially to ask each other conversations. I know that some of you have been responding to certain questions in the Q&A screen. And Matt, do you want to kind of take it over? I don't know if we want to review any of those questions. If they seem like it, I hand the reins over to you.
Yeah, no, thank you. This has been a great conversation so far. So I'm Matt Kropp, Executive Director of the Vermont Employee Ownership Center, and we work with all three of these models to some extent, which is so it's fun to hear the crosstalk. So there, I do see one of the, or a few of these questions kind of did go into the questions of kind of B Corps. So it seems like there's some interest there. And I know, Jim, with Gardner Supply, for instance, being both an ESOP and a B Corp, do you want to maybe just talk? I see there's some text answers, but do you maybe want to talk a little bit about the overlap and maybe how you think maybe folks, as they're thinking about these models and investing, might view sort of the B Corp as a piece of their consideration.
Sure. In case people aren't familiar, I'll try to do just 2 minutes on what we're talking about here. Unlike a legal format like a C Corp or an S Corp, a B Corp specifically is a voluntary earned certification certifying to the socially responsible business practices through an organization called B Lab. So you take an assessment, and if you score properly in terms of environmental practices, labor practices, and so forth, you can earn the designation of being a B Corp, which is a great way, particularly for us, like a consumer company, for consumers to spend their dollars, or even working with other businesses to work with other businesses that share our values. There's a higher level, which is called a benefit corp, which is where you actually change your charter and bylaws to reflect that the purpose of business is not only the traditional view to maximize just shareholder value, but in fact to really consider the needs of all stakeholders in the decisions. And it protects decision makers in terms of making decisions that maybe don't boost share value. It's often sometimes called colloquially the Ben and Jerry's law, because Ben and Jerry's, some were perceived were forced to sell because shareholders wanted that premium price, and they weren't allowed to consider these other considerations like we're talking about here, like effect on the community or business practices. Those, I think, fit very well with the models that we're talking. I think they go hand in hand. We are both a B Corp and now, in fact, a benefit corp. And it's a way that we really, by charter, are locking in the principles by which we're based. It's probably how we would operate anyway, and it's very natural fit with employee ownership, I think co-op ownership, and with a perpetual trust or a steward trust can be also very much written in. But it's a side-by-side piece that very often is yet another way to achieve the goal that we're talking about, which is to consider the effect on all stakeholders and the community in the decisions that we make.
I do think it's important to say, like, we are all here interested in real ownership as like the mechanism for accountability. And I think that's a key distinction between what we're talking about in any of these models and the B Corp, right? Like, the reality is that if enough shareholders decide that the B Corp is inconvenient, they can change it. In a worker co-op or a stewardship form or an ESOP, like a democratic ESOP, you have to get the consent of the people who are creating the value in order to do that type of thing. And that's a really, really different type of accountability. Like a certification is a sort of outside third party verification, whereas sovereignty or self-determination is a really different mechanism for actually creating accountability. And I think that's something that we're all kind of here to say is, the future and what we want to see.
Yeah, Oh, go ahead, Alan.
I was actually going to go a different direction, but if there's more discussion of the B Corp, we can stay there.
I was just going to say, I mean, I think Ben and Jerry is such a great real world example, right? I mean, how heartbreaking was that for all of us? And I think what we're arguing for in many ways is that, any of these vehicles could have locked in the mission of a Ben and Jerry's in a different ownership structure, while providing a return to the founders, right? Through whether it became an ESOP or worker owned or steward ownership is, we could have created an ownership structure and created an exit for founders using one of these structures.
Go ahead, Alan.
Hey, yeah, Greg, I'd kind of like to hear your thoughts on what kind of considerations are you taking into in your commingled investment fund as far as the portfolio of returns that you're creating? I mean, obviously there's a monetary return coming back to the fund, but are you looking at all at a portfolio of other types of returns? We've talked about a lot of other returns today, the community, other stakeholders. One that goes through my head is, how do you invest in improving Lake Champlain? Do you think at all about the other returns and how they fit into your portfolio?
Yeah, social impact is one of our 4 basic deal criteria points. So yeah, we do, and I just want to say, it was so fascinating to hear your story of the ways that I think being, a lot of co-ops are limited to debt financing, and to hear your story about the struggles you guys had with that. I think that's why we want to experiment with a dedicated equity fund, because there's not been a dedicated equity fund in the co-op space. I think it's held back. Maybe it wouldn't have solved what you were dealing with, but I think we want to see, if cooperators had all the sets of tools, could they finance more deals and grow the sector?
I would say it definitely could have. And one of my goals in talking as much as I can is to try to create bigger pools of money, Greg, that are going to get to that and find different ways to finance any of these methods that we've heard about. And there's probably others as well. I'm relatively agnostic as to which model gets used. I like the ideas that get pushed, that this is not a point for an exit. It has to be a broad-based decision to do something like straight exit. And, those things together, as we talked about, I'm looking for ways to try to build bigger pools that are ready to act, because that's also been something that holds back the world, is that some pools are very slow to act.
So,
If I could just chime in on that, Alan, I think, this has come up a couple of times, and I think can't be emphasized enough, that the traditional exit where there just is a large buyout and sort of is just so anathema to this business model. And as an investor personally, I see that as, if I'm looking at a company and investing in, to see that there's a realistic opportunity for long-term stable cash flow that can service debt and offer an ongoing dividend, that actually seems like a lot more stable company than a sort of hope and a prayer on a hockey stick and outlandish projections that are going to have 10x returns, because they are all going to have 10x returns. Is just like I get tired of looking at them. Personally, this is my personal opinion. And I also think that, for another thing that's just a side note on this is that the tax consequences of a large sale are actually problematic versus a stable return. There are significant benefits on the investor side. And I always love the Warren Buffett quote of, we look at these companies and we buy them, and we're always looking for a, quote, bigger fool to buy them at a larger exit in this future valuation that may or may not ever happen, and often doesn't. So I think that just that framing, a different mentality about that the only way to get a return is just these astronomical exits is just, I hope that we can reframe these as real viable alternatives to that. Thank you.
All right, so Jim, and then I'll kind of get to another one of the questions from the audience here.
Sorry if we're among ourselves sucking all the air out of the Q&A, but this could be a very valid question, which is, do you have to accept what are the buzzword is concessionary returns, meaning a lower return because you're investing based on your principles? And I think Aaron makes a very good point. Even for any investor, it's a portfolio approach. But really the question is, can you achieve social good and achieve adequate returns? And in many of these models, I think absolutely. And in fact, when you think about some of the other benefits or even the risk portfolio, many of these are lower risk for many reasons, if only because of the employee engagement that they create and the alignment that they create. So I think that's, it's almost that there was a buzz for a while, which is we want impact investing, but no, we're not going to take any concessions, and that's how we could really feel good about ourselves. I think we need to change the dialogue about that topic altogether.
So I'm going to combine two questions here, sort of, that I think are related. But one is more and to a certain extent, when I was on the sort of starting local investing 101, and a big thing that kept coming up again and again was deal flow. How do you find investment opportunities, right? So what, maybe, and this just kind of throw out, where should, first of all, just people in general be looking for? And then for the folks who are coming in at the more small dollar level, who are not accredited investors, but want to sort of put something towards that, I have a few thoughts, but I'd love to maybe start off by just hearing, how can people find these sorts of things when it's not as easy as just looking on your stock trading app or and what your 401k offers in terms of where to invest, right? There's more intentionality that has to come in finding these things. So any thoughts on that?
Well, yeah, I'll just fill in quickly from, oh, go ahead. I'm sorry. I'll keep jumping in.
I was just on the small basis, Matt, there is an investment club that we have started, Vermont investment club, that is investing in co-ops. We're out looking for new investments monthly. You can start out small. The club has built up to $55,000 at this point, and with a few more members, I mean, we could be adding thousands of dollars a month to our ability to invest. So that's one place for a very small investor.
Great. And also on the co-op side, yeah, there's 4 co-op loan funds. If you go to start.coop and you look for our additional resources page, we'd list the co-op loan funds if you want to lend through them. Our equity fund is right now only open to accredited investors. We hope to come back and do an offering for unaccredited later in the year. But that's one of the challenges we've heard from people, is that there's actually a lot of co-ops looking to raise money, but it's been hard to find them because they're each on their own, and often with securities regulations, they can't publicly advertise it. So it's been a problem just connecting the sides.
All right, so kind of another question that I think is kind of interesting is around the pros and cons of starting your company with an ownership structure like this versus kind of going in and seeing this as kind of as an exit path. Are there certain, what do folks kind of think about that in terms of the just in terms of if someone's an entrepreneur thinking about this as a desirable future for their company, which way to go, or certain considerations around that?
Well, I can maybe start it off. Again, some of these models, some are appropriate, I think, at the startup phase, and others, like ESOPs, are really not a startup phase. I think maybe part of the consideration, though, is that is the risk that it also represents to those employee owners. And I think if they didn't go in knowing what that risk is, then it can be a model that can be adopted very soon in a place like well, speaking of examples, but for others, given the high risk that's inherent in a startup to begin with, I think it can be appropriate, perhaps, that the entrepreneur takes some of the disproportionate risk, or other investors take the disproportionate risk, with a business plan that is clear that the intent is to move to this model once you're past that startup hurdle.
Yeah, I wanted to add on to that point about risk. I think that, excuse me, we tend to advise people to move towards these forms over time, especially for startup type of companies. I think there can be benefits to, especially if the business model of your company is about creating trust and making sure that your stakeholders are engaged and all these other things. Like, there's some really good examples in the Start.coop portfolio of companies that, them being started as co-ops is sort of key to their business strategy. And I think that's a good reason to do it. When we see more like conventional companies come through that are interested in steward ownership or some hybrid form of any of these, we tend to advise them to like take steps towards it over time, because it's a little bit hard to talk about, but it's like, to do really good co-governance and collaborative strategy and cooperative management, even if it's in a steward ownership form, it's a skill that not everyone has developed. And so to immediately go from I'm, a worker to I'm a worker owner, and I'm now responsible for all of these decisions, and I am holding all the risk in terms of my salary and my ownership and maybe my retirement funds. Like, it's a lot to ask of people. So I think it's important to be compassionate in terms of like how you move towards these types of structures and how you include folks progressively, and just making sure that you're like taking a really like training based in HR, like an intentional HR approach is really important. Just like giving people shares, when they like don't have an accountant, and also maybe, especially in a lot of the companies we work with, which are, the workers are more folks from marginalized communities, like there's a lot there that comes up and that needs to be like, there's education that needs to happen. There's training, there's like accounting, there's like bookkeeping, there's all kinds of stuff that becoming a business owner is non-trivial.
Yeah, and I'll just add, again, what they all have in common is this intention of how do we share the wealth of entrepreneurship, right? And so it's really a function of where you are on your journey, and rather than just sharing that wealth with the other investors, first of all, do you want to share with other people, and who do you want to share it with? And then I think it's kind of a series of decisions of how you get there.
Great. So we're just about at time. So final question, and then maybe just kind of a quick closing round. So I think this is one that maybe Arian might be able to provide some insight into, which is specifically around the steward ownership and Vermont. So what do you see as kind of the status of it now, and what work kind of is being done or needs to be done to make that model kind of more visible in Vermont?
Gosh, I think that having more conversations like this, and one of the things that I really appreciate of Vermont, and I'm sure most people who are in Vermont appreciate as well, is that it is a small community, and we can get to know each other, and we can work together rather than working in some larger states and just bigger, or nationally, it can be really confusing and pulled in a lot of different directions. And so, one of the things that, putting my I don't represent the Vermont Community Foundation, but I am a member and a fund holder. And I would definitely say that if the Community Foundation, I'm not putting words in their mouth, has stated a specific interest in pursuing funds in this area from all levels of leadership. And I think that there are other great mechanisms like your organization, Matt, and some of these investor clubs. But I would specifically, my last little plug would be, I'll put my email in the chat. And if you are part of the Community Foundation, I would ask that other members please contact me if this is something you're interested in. And because I think we can work together within the foundation to try to push that forward.
Great. So quick round, final thoughts, any sort of last things you'd like to leave people with, maybe starting with Alan.
Thanks, Matt. And thank you, everybody, for showing up. I would just, one thing I heard late that I would like to echo is, evaluate these things like any investment and put in the time. And, I think that we saw that example of someone who knew the industry before they looked at our investment. That is extremely valuable. And I think it's important that we build up the knowledge of these ideas so that, the investigation stage that Derek touched upon is much shorter for folks. Thanks.
Great. Greg, you want to go next?
Yeah, I'll just say, I'm talking to more and more investors that feel this gap between where their money is invested and what their values are, right? And I think there are all these exciting new alternatives in alternative ownership of how to bring that gap closer together. And so I think I just encourage you to explore the options, and obviously don't move all of your portfolio over on day one, but start learning about these options so you can create the economy we all want.
Great. Jim?
Yeah, I'll jump on that. There was a great discussion yesterday, Hulu discussion about trying to bring money and incubate businesses here. And it's not only creating them, it's retaining them. And so I think it takes the entire investor community to be open and, in fact, support alternative models, because I think that's one of the best ways that a small and more geographically distant state like Vermont can be competitive with building our own economy and from the ground up.
And Derek?
Yeah, I just agree with everything that everybody has brought up on this panel. I think that alternative ownership writ large is this secret weapon in the tool belt of like creating a more fair, more competitive local economy. And so thing I always end with is just like, I encourage anyone who has the financial capacity to invest at all to go do a deal. Can be a small check, can be a, small, 10% ESOP or whatever. Like, find something that speaks to you and do one of these deals, because the process actually will, I suspect the process of doing these deals actually transforms how you look at all of the other deals that come across your portfolio. So that's my biggest piece of advice, is just like get some money into movement. And I think you will not regret it, and you'll learn a ton.
Great, thank you. And thank you so much to the Community Foundation and all our panelists for sharing their experiences and wisdom here. This has been a great conversation, and hopefully we'll inspire a little bit, inspire some greater investment in these sorts of structures. So thank you for attending today.
Thank you, and thanks to Kim Haggis, who's behind the scenes at BCF, who's doing a lot of orchestration. So just want to
Thanks, Kim.
Thank you, Kim.
All right,
Thanks
to our
everybody.
speakers.
Thanks, Bill.
Yeah,
Thanks.
everybody take care.